Picture this. A storm rages, not just in the skies, but in the global economy. Climate change isn't just melting ice caps, it's melting entire nations' financial futures. Could the next big crisis be countries going bankrupt due to climate disasters? Welcome to Economy Unpacked Daily YouTube channel. From Wall Street to your street, we share the world of money in a clear way. When we think of climate change, we often picture polar bears on shrinking ice floes. But for millions around the world, it's not just about wildlife, it's about their wallets. Climate change is both an environmental and economic crisis, threatening to bankrupt entire nations and reshape the global financial landscape. The harsh reality is that the poorest countries, those who contributed least to global emissions, are bearing the brunt of climate change's economic impact. These nations lack the robust infrastructure, insurance systems, and financial reserves to weather the storm, both literally and figuratively. A hurricane that merely inconveniences a wealthy nation can completely devastate a poor country's economy. So, let's dive into the economic toll of climate change. For many developing nations, agriculture and fisheries form the backbone of their economies. But as climate patterns shift, so does their economic stability. Droughts shrink crop yields, floods wash away fertile soil, and warming oceans decimate fish populations. This doesn't just mean empty plates, it means empty coffers as export revenues plummet. Infrastructure, the skeleton of any economy, is another casualty. Roads, schools, and hospitals, the very foundations of societal progress, are repeatedly destroyed by increasingly frequent and severe weather events. While a wealthy nation might grumble at the billion-dollar price tag to replace a bridge, for a developing country, that cost could equal a significant chunk of their entire GDP. Take Mozambique, for instance. Cyclones have repeatedly ravaged its coastline, destroying homes and power grids. Or consider Bangladesh, where constant flooding threatens both agriculture and housing. And let's not forget the Pacific Islands, where rising seas threaten not just economies but the very existence of entire nations. The cruel math of climate disasters becomes clear when we compare the cost of rebuilding to the size of these economies. A storm causing $1 billion in damage is a setback for the United States, but it's a potential death knell for a nation with a GDP of only $10 to $20 billion. This brings us to the debt trap. Without strong financial reserves, developing nations often have no choice but to borrow heavily to finance recovery and rebuilding efforts. But here's the catch-22. These climate disasters simultaneously shrink their GDP by destroying productive capacity. The result? Skyrocketing debt-to-GDP ratios, a key measure of a nation's financial health. It's a vicious cycle. Higher debt means less money available for climate adaptation projects like building seawalls or drought-resistant agriculture systems. As countries neglect these crucial adaptations, they become even more vulnerable to future disasters, leading to more destruction and more borrowing. It's a downward spiral that's hard to escape. The Caribbean offers a stark illustration of this problem. Nations like Dominica and Grenada have seen single hurricane seasons wipe out more than their entire year GDP, forced to rebuild through debt. They find themselves trapped in a cycle of dependency and vulnerability that seems impossible to break. Now, you might be thinking, surely the international community is helping. Well, yes and no. The 2009 Paris Agreement included a pledge from wealthy nations to mobilize $100 billion annually by 2020 to help poorer countries cope with climate change. But year after year, this promise remains largely unfulfilled, with funds falling short by tens of billions. Why? Part of the problem lies with private investors. They see poor, climate-vulnerable nations as too risky for large-scale green projects. It's a cruel irony. The countries most in need of investment are the least likely to receive it. Politics also plays a role. Developing nations argue, with good reason, that rich countries have a moral duty to pay given their historical responsibility for emissions. But wealthy nations often frame climate finance as charity rather than responsibility, creating tension and undermining trust. To make matters worse, much of what counts as climate finance comes in the form of loans, not grants. This approach deepens the debt burden rather than easing it, fueling resentment and skepticism among recipient nations. So, what solutions are on the table? Climate insurance schemes are often touted, but they have limited coverage and high premiums. For many vulnerable nations, these premiums are simply unaffordable, and payouts rarely cover the full extent of damages. Green bonds offer another avenue, allowing governments to raise money specifically for environmentally friendly projects. But they require investor trust and sound financial governance, qualities that many struggling nations find hard to demonstrate. An innovative approach gaining traction is the concept of debt for climate swaps. Here's how it works. Creditors forgive part of a country's debt in exchange for commitments to climate-friendly policies. The Seychelles, for example, swapped debt for a promise to protect its marine ecosystems. Global institutions like the IMF and World Bank could play a crucial role by providing concessional finance, facilitating debt relief, and standardizing climate risk assessments. However, they face criticism for slow action and for attaching stringent conditions to their loans. Now, you might be wondering why the financial instability of poor nations matters to the rest of the world. The truth is, in our interconnected global economy, no nation is an island. Failing states, collapsing economies, and food insecurity create ripple effects that touch us all. Millions displaced by climate events may migrate northward, straining borders in the U.S. and Europe. Disrupted agricultural or resource supply chains affect global prices hitting consumers worldwide. Financial collapse can trigger political instability, creating security concerns that extend far beyond national borders. In the intricate web of global markets, a debt default in a climate-vulnerable country can shake investor confidence and impact credit markets worldwide. This means that climate finance is just a humanitarian issue. It's in the self-interest of rich nations to ensure global economic stability. As we wrap up, it's clear that climate change is redrawing the financial map of our world. It's determining economic winners and losers, and in some cases, threatening the very existence of nations. The survival of vulnerable countries depends on global solidarity and a reimagining of our financial systems. We need urgent action. Reform of global financial structures, delivery on climate finance promises, and a commitment to climate justice. The stakes couldn't be higher. So, let me leave you with this thought. Should rich countries pay for the climate damages they caused, or should developing nations be left to shoulder the costs of a crisis they did create? The answer to this question may well shape the future of our global economy and our planet.